Well, it's very simple. What you need to do is to risk only a maximum of about 3% of your capital per trade. So what I'm saying is if you have, let's say, a £10,000 account, you shouldn't risk more than £300 per trade. And what I often see is people risking £1,000 per trade, for example. When I say per trade, that is if they, for example, buy the market and they have a stop loss in place, and that, if that were triggered, would lose them £1,000. So what you need to do is to trade very small, because don't forget, if you trade leverage trading, 95% of the collateral is actually provided by your broker. You're just putting down 5% in most cases of the the underlying asset, and therefore you're trading the full size, yet you only put down a marginal or a small amount of money to do so. So you can benefit from the big gains, but you can also unfortunately get it wrong and lose a lot of money very, very quickly. So what you need to do is to trade small, and percentage-wise, think of your capital in total as a percentage, because even if you trade 10% of your capital per trade, in our example I just mentioned, £1,000, if you have £10,000, if you get 5 trades wrong in a row, you've lost 50%, half of your money. You then need to make 100% just to get back to break even to where you started off from. And that happens quite easily. If you go to a casino, if you bet on black, you could get 5 reds in a row. The more you basically gamble, the more often that happens. And it's the same with trading.